All right, we're going to let everybody join on the line here. Give us just a few minutes or a few seconds. How about that? Happy Monday. Well, welcome everybody. It is that time of the month again, and we're excited to bring you this month's market update. I'm Greg Patterson, and I'm joined with my teammates, J.A. Kennedy and Tara Gould, and we're with Atlantic Wealth Management here in Morehead City. And this is our September market and economic update. It's our 8th one this year, and we're excited to bring these bits of information to you. We've had a busy summer and, of course, a full slate of economic data to share with you today. And each month we strive to bring you the latest on markets and the economy, as well as our thoughts, and give you some perspective about where we think we're headed. We hope that these virtual meetings are valuable for you and your loved ones, and we look forward to bringing them to you throughout the rest of this year. If you do have questions or something that we talk about on today's webinar, is something that you want to ask us more about, you can certainly email your questions or feedback, and you would do that by emailing Mackenzie here at our office. Her email is mackenzie@myatlanticwealth.com. That's MACKENZIE. Or you could always call us at 252-515-7800. We always appreciate your questions and welcome any feedback that you have. Lastly, as we host these calls on a monthly basis, we do record them. It takes us about a week or two to get our compliance team to approve them, and then we post them back out on our website. So they are there and accessible for you to send to friends or family who you think may benefit from our thoughts. And for that matter, for any of the work that we do, if we can help someone that you care about, go ahead and use our website as a pointer to share with folks. So with that, we have a lot to get covered today, so let's get started. We're going to take just a minute to go over our agenda. As in most of these broadcasts, we're going to talk about current market returns, and we'll give you a couple of slides. Tara will go over those and give you some perspective around that. We're going to talk about the consumer price index and the producer price index and the trends that we see there. These are inflationary trends. Jay is going to give us an update on the latest economic data. We're going to talk about the U.S. recession indicators, so that dashboard of indicators that we look at. Also, our topic for this month is going to be talking about insurance coverage analysis and things to consider there. Tara's going to be going over that. And then we'll share some conclusions and parting thoughts. We're going to try to get this done today in 30 minutes. That's a tall order. So let's get started. Tara, take it away. Tell us a little bit about what's going on in the current markets.
All right, sounds good. I do love to talk about the markets. So the first chart that we're looking at today is S&P 500 year to date. So that's going to put us January 1st through today. Actually, this is Friday market close. S&P 500, anytime you hear that, remember it's the 500 leading publicly traded companies. This is a common benchmark that we use on the equity side, and it is considered one of the best gauges of the overall U.S. equities market. So the most recent year-to-date low occurred towards the beginning of the year in January at around 3,800. And I'm happy to report that we are trading at that 4,450 range, slightly less. I was looking right before we hopped on. So we started the year around 3,800, so that puts us at a year-to-date increase of around 16%. Another look at the S&P 500, so this is a one-year look. And this is where, if you look at the bottom of the chart, these 52-week highs and lows come into play. So you'll see that 52-week high at just over 4,700 and the low at 3,491. And as mentioned before, we're trading around that 4,450. So that puts us 52-week the 52-week at 14%. And one more, as we take a just wider view at the S&P 500 over the past years. Just thinking about the past years in this time frame, we had a low in March 2020 where the index did dip down into that 2,300 range. And then we had a high trading in December of 2021. If you remember that, S&P 500 was at around 4,700. And that was December 2021 into January 2022. And what this perspective shows us is it's always good to look at a longer term perspective, but it shows us we are back on that climb, but we have not quite made it back to those highs of that December 2021, January 2022. We're still a few points off, so we have some room to grow here. Next, we take a look at NASDAQ. NASDAQ is another common index that you're going to hear quoted, and this is just a staple of the financial markets. It has over 3,700 company stock. It's heavily weighted in technology. And as we see the returns, you'll see that reflected as well. So more than half of the index is going to be tech companies. NASDAQ had a year-to-date low, again, at the beginning of the year. So this actually occurred on January, around that same time frame. And that low was around 10,305. The high for the year to date is still sitting in July at 14,358. So we started the year, the index at around 10,386, and we're currently trading right now at around 13,700. That puts us of a year to date increase of over 31, almost 32%. And then next we have the 1 year look at the NASDAQ. Again, those 52-week highs and lows that you can see. And so this is going to put us September through September. And this increase is 19, almost 20% on the year over year. And then lastly, for market updates, again, taking a step back and looking at the 5-year view just to get a better perspective. Over the past 5 years, the NASDAQ index is up over 71%, which is amazing. As similar, the S&P 500 on the NASDAQ, the peak January 2022, that time frame that I was talking about, and the high point on the 5-year range has been at 15,600. So you can see where we're trading today. We still have some upward movement to that high.
All right, so a couple of quick charts on the consumer price index. So the chart you're looking at right now is a 12-month change in CPI, which is what the consumer would see month to month. That's indicated by the red item, less food and energy. And then the blue line there is all items together. This is looking at August 2022 to August 2023. This number just came out last week and was reported with an increase. You can see that to your far right-hand side, how it has tracked upward from June, July, and most recently the August number. We think that's due in large part because of the big spike in energy prices. All of us have felt that at the pumps, but it certainly is translating into higher prices in other areas as well. The red is less food and energy. Those tend to be volatile, but I don't know of any report that would be meaningful without those two items because American households pay for energy and food every month in their list of goods and services that they buy. So our thought is, and we are seeing this play out, is that prices are rising relative to energy prices. We think that's a continuation as we go forward, just from what we see within the energy sector. So it leads us to believe that Fed will raise rates this week. I know Jay is going to talk a little bit about that, but this is why. When you think about inflation and how your own family is impacted by it, this is the chart that you want to look at. Yes, the 12-month change has come down from the high of last summer, And that has, we've seen that particularly in construction and building materials, but it still hasn't been to that 2% target that the Fed really wants to see. So consequently, we believe that they'll take, the Fed being they, will take a very aggressive approach as they have been. So if we take a look at the next picture here of the CPI numbers, this is just looking at the month-to-month change. And you can see the big spike to the far right with August numbers coming in. There's no way to downplay that. It is still an issue. And again, our thoughts are until we get energy prices under control, it will continue to be an issue. Jay, I know you're going to speak a little bit about that, but that's kind of in a nutshell what we're looking at from rising prices. It has definitely been one of the headwinds. The double threat is rising inflation, and of course, because of that, rising interest rates.
Yeah, agreed on that. With the food and energy definitely being what we've seen spike of late. But also to put things in perspective, even at the 3.6 or 7% CPI, a year ago that was running over 9%. So we still have come a long way. We were on a downward trend until a couple months ago. We got down to 3%, and then we've ticked up slightly, primarily because of energy.
Yeah, I think the August energy index was up 5.6%, I believe, for that number. So that was the big contributor.
All right. Well, good afternoon, everybody. We always like to dive in and take just a kind of a general look across the board in terms of economic data since we last met via webinar, and just give you guys an update. We already talked about inflation and CPI. PPI is the producer price index. So that just measures inputs from a producer standpoint. And that index is up 1.6% year over year. So it's followed a similar trend of CPI. It was lower a couple months ago, has ticked up a little bit since that time, but still that's a low, that's under 2% on the PPI. And so we would expect that the CPI to kind of track the PPI over time. From an employment standpoint, we always have a month-end jobs report that comes out at the beginning of each month. So this is a little bit dated, going back to the beginning of September. We did have an unemployment tick up slightly, though, up to 3.8%, which is the highest we've seen in quite some time. But when you look into the details of the numbers, on the encouraging side of things, we had almost 750,000 people come back into the job market. So 736,000 increase in the labor force. And that brought the participation rate up to almost 63%, which is the highest we've seen since COVID. So that would be encouraging on the employment side of things, even though the unemployment rate did jump up. We also track initial jobless claims, and they have remained, the 4-week averages remain in the 225,000 initial jobless claims range, which we would say is a healthy level, not anything to be alarmed at to this point yet. The housing market, as we've talked about before, really it's been more difficult for existing home sales, an easier path for new home sales, just because of the interest rate environment. And so new home sales are up over 31% year over year. Existing home sales are down 16+%. So pricing has remained pretty stable. So we've seen the median home prices. If we look a year ago, new home prices have come down a little bit. Existing home prices have gone up. It kind of dovetails along the same lines, and for the same reasons that we've seen that trend in the number of sales. Retail sales, we've continued to see consumers spend money, and so the latest retail sales report year over year number had an increase of 2.5% from retail sales. As long as we continue to see consumer spending money, that does prop up the economy and lead us to economic growth. When we see consumers change their spending habits, stop spending as much, that's when we begin to get concerned about negative growth and recession scenarios. Industrial production, we have for the last couple months seen surprises to the upside. And so we'll continue to monitor that to see if that trend continues, but that's the latest from an industrial production standpoint. And then GDP, which stands for gross domestic product, is how we measure economic growth. We did have the estimate for the second quarter, the second estimate for the second quarter that came in at the end of last month, reduced the second quarter GDP from 2.4% to 2.1%. But if we look back to the first quarter, we had 2% growth. Second quarter, 2.1%. We'll have another revision to that before the end of this month. It's worth noting, though, and we talked about this last month, the projections for the third quarter GDP are much higher. Last month, I think we had communicated that the Atlanta Fed has third quarter GDP projected at 5.6%. They just revised that number down last week slightly, but still at 4.9%. So more than double what we've seen on an annualized rate the first and second quarter, at least from a projection standpoint for the third quarter. And then lastly, the Fed is meeting this week. And if we go back several months, the Fed, when they first paused and didn't increase, they said they may have another couple of increases in their pocket, and we've seen one. We think probably over the next two meetings, whether or not that's this week or the next meeting, that we may see another one. We do feel like if they don't increase it this week, then they'll at least hold that out there as a potential for the next meeting. If you look at what the market thinks we may not see an increase this week, but the Fed has been known to surprise the market from time to time too. So we'll be on watch and on the lookout when they come out with their announcement on Wednesday this week. And that brings me to the headline of the week, which I thought this picture was interesting and somewhat comical when you read the headlines there, but also insightful and telling about the environment that we find ourselves in. If you see this picture here, the city economists say the U.S. recession might be pushed out. But in the same clip, at the bottom, the subtitle says Yellen, or it says Yellen, this was a quote from her, that the U.S. is on path to sticking to a soft landing, which would mean staving off recession. So city economists saying still going to have a recession, just pushed out. Yellen saying we're going to have a soft landing. It's kind of the nature of the beast when you go out today and look at what economists are saying. You get a mixed bag in terms of projections. It's very difficult to predict. And we've talked before about the reasons why that is today. But I thought that was interesting, and that this is from last week, a headline of the week.
Yeah, it's interesting you bring that up too, because our outlooks at the end of the year for this year that are put out by leading economists, the majority of them said to expect recession by second quarter of this year. Well, we're in the third quarter and so far no recession. And also those outlooks are updated in June of each year too, called a mid-year outlook. They've pushed it back with several of them saying second quarter of next year. So if you were trying to make plans based on that, it would be a moving goalposts, right?
Yep.
So we've always thought that clients would be best served to have their longer term retirement money at work and their shorter term money that they would need within the next couple of years in bank savings, money market rates, CDs, those types of things. And that way they can weather any type of short-term economic storm. We come back to the U.S. recession risk indicators. This is put out by Franklin Templeton. Their ClearBridge arm puts this out each month, and it's updated. The last update was of August 31st, month end. And they've been doing this since January of 2016. So it provides some consistent indicators around looking at a recession. The red X, of course, means deep in recession territory. The yellow is cautionary, and the green is expansionary. And you can see the August column, most of those indicators, with the exception of two, are red X's, contrasted with September of last year, where you still had three that were expansionary and three that were cautionary. So it has changed, and the outlook has pointed towards recessionary, although no one knows exactly when. The overall signal, however, for the month end of August is recessionary by ClearBridge. One of the things to look at here is the yield curve. It's the bottom X. And we have seen the most dramatic pace of tightening from our Federal Reserve probably in 2 generations, but we feel like it might be nearing the completion of their hiking cycle. And historically, as a result of that, equities tend to follow a similar pattern in the period leading up to that final rate hike. But the performance of equities following the last rate hike has had a much wider range of outcomes, depending on whether the economy falls into a recession or it skirts it with a soft landing. It's interesting to see how the 10-year Treasury yield has performed as well. Basically, a 100 basis point increase from its April lows to its recent highs in August, with just over half of that occurring between mid-July and late August. So again, this is a signal for us that perhaps the Fed is nearing the top of their rate hike cycle. And interestingly enough, we can see out in just CD rates that we have access to for our clients, the 18-month rate is lower than the 12-month rate. So that also can support the fact that we believe the Fed might be nearing that rate hike cycle. And as such, if we have a soft landing and avoid a recession, equities perform well. If not, then again, it's a case for a balanced and diversified portfolio with not all of your eggs in the equity basket. So that's some perspective around that. We're not going to try to catch the falling knife. We're going to let it fall on the floor and then pick it up. But we do have a very forward process with managing investment portfolios that looks at these items.
Interesting on the just a quick comment on interest rates and the Fed. I did look out to see what the expectations are for the end of year 2024 and 2025, which both are a ways out, but the Fed funds rate is we're projected to have a point decrease off of where we are currently by the end of next year, and then down to 2% by the end of 2025. Now, that's a long ways off in terms of projections and predictions, but that kind of lets you know what the trend expected is going to be.
And the charts that Tara put up at the beginning, I think the reality is that stocks outperform bonds, which outperform cash over the longer cycle. And what we would tell our clients, and we do this on a regular basis, is for those who are comfortable with a 55-mile-an-hour risk tolerance, they should expect, a healthy expectation is 2 negative years of equity returns out of that 10-year decade. And that typically is played through, although it's not a guarantee of future performance, it certainly is what's happened in the past. So a recession is a normal part of the economy. For folks who make you think that the sky's fallen, I would say that's not true. The U.S. Is the world's largest economy, and we're not doom and gloom thought. We don't have a doom and gloom thought or outlook on this, but just a healthy perspective that recessions do happen and they end, and we go on and see expansion as well. So this is proof of that over the last many different recessions. You can see the dashboard of indicators there. From the current perspective, all the way on the left-hand side, and then following each of those recessions back to the recession of 69, 70. They tend to have similar characteristics. And had you invested money in 1969 and 1970, you would certainly be really glad that you stayed invested over those time periods. Again, you wouldn't put all your money there, but even helping a client recently with cost basis with Home Depot shares going back to 1991. Home Depot hasn't always gone up, but the trend has been up over that time period, and the client's been well rewarded for holding it. So just some perspective around that.
All right, and I'm jumping in. I'm going to switch gears a little bit. Each month we have been highlighting a financial planning topic. And the goal behind this is just to share through these webinars topics of interest and what we believe importance. When we outline our plan for these webinars, we think through collectively what we see most often when working with our clients. And so it's just a really good platform to be able to bring these ideas up. And so this month's focus is insurance. And part of the comprehensive planning process. So when we talk about financial planning, we're not talking about doing really well in one segment. We're talking about this comprehensive process when it comes to investments, comes to cash flow planning. This also includes insurance. And so just part of our process is helping you gather this information as well as analyze your coverage. And so we have this graphic today of just a way to think through, and also if you don't have written down or you don't have a place where you have collectively your insurance policies put together, we do have a template. We will keep track of this as well as be able to share with your loved ones in the event that something were to happen to you. But we want to know from an insurance standpoint, when, how much, what type of insurance are you carrying, whether it be home, auto, life, liability, long-term care. It's important from our perspective to at least do an annual analysis. And this is just to be able to assess where you are, but also be able to identify any risk. So from a planning standpoint, I want to know coverage amounts. I want to know who's insured. How much are you paying for this? And I'm going to ask you the question, when's the last time you have shopped around? So people will sometimes get in the habit of something like auto insurance or homeowners insurance. I'm just going to stick with the company that I've had with for X number of years. But we would encourage you to take a look at what else is out in the marketplace.
Yeah, it's good. I think it's a good matter of policy to look at this on a regular basis, and then be able to communicate it to your loved ones.
Absolutely. Jay, did you have something?
I was just saying thank you. I mean, another life insurance is a big one, but also like with homeowners insurance, if you don't regularly review and increase that over time as home values have gone up, if you haven't looked at it in a while, you probably definitely should take a look at what you're insuring, and if it is in line with current values.
Absolutely.
All right, that brings us to, we always like to close with some biblical wisdom and truth from God's word, and just pulled out these couple of verses from Isaiah 55, chapter 55, verses 8 and 9. For my thoughts are not your thoughts, neither are your ways my ways, declares the Lord. For as the heavens are higher than the earth, so are my ways higher than your ways, and my thoughts than your thoughts. And I think it's Greg talked about doom and gloom. It's easy to get drawn in and sucked in to a lot of negativity, whether it's doom and gloom about the future or the economy or political environment or society, whatever, fill in the blank with any number of different things. But for me, this scripture brings me back to reality and truth, that nothing happening today or that ever will happen in the future catches our Heavenly Father by surprise. And so he's over it all. And that's what I'm reminded, that I need to put my trust and my confidence and dependence on. And I would just encourage each of us in that, when the world is fighting for our attention, it's easy to get sucked in, for us to be reminded of who is over it all and in control. And that wraps up our presentation for today. We do thank each one of you for joining us on the call, on the webinar. And we are here to serve folks and to be a resource. So if you have questions about anything that we mentioned or talked about, or anything that we didn't, that you think we could be of assistance with, please reach out to us. And that also goes for friends, family, loved ones, neighbors, coworkers who might benefit from a conversation with us. We'd be happy to do that. And we do enjoy helping folks, and we welcome that opportunity just to continue to help others. So we do have our next webinar scheduled next month for the 23rd, I think Monday the 23rd at 4 o'clock. So we'll be communicating with you on that before then. In the meantime, we'll be getting this out on our website, posted. If it's something you would like to share with others or go back and take a look at, we'll have that out there and we'll communicate that as well. But otherwise, we appreciate your time. Thank you for joining us today, and we hope you all have a great week, and God bless.
Bye.
See you guys.